Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the hosts, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Good morning, everyone. I hope everyone is having a good start today, Thursday, and it's been a great week so far. If you haven't been on any of the podcasts before and you're new, my name is Alex. I'm part of the financial planning team and part of the 6-star team as well. So welcome, and let's dive into today's episode. So what I want to share with you today is really, some of my conversations at a high level that I have with clients that come to me seeking to purchase a property, right? So, typical question that I get asked, or why a client comes to us to seek advice, is really goes down the line of, hey, buying a property, want to acquire 5, 6, 7, 10 properties. How do I do it, right? So, where do I begin? Number one, it's all about who's your accountant, right? Let's get the accountant into the conversation and make sure that everyone is across what you are about to embark on. And the second question that we speak about is really all about structuring, right? So that's, I guess, the theme for today's episode, which is structuring your property purchase. Okay, so let's start, at a high level, super simple, right? What are your options, right? That's why you come in. You want to know your options. You want to know what the consequences are, and then make a decision from there. So step one, you could be a single person or a couple. Naturally you would go out there and you buy it in your personal name. Great. What are the consequences of that? Let's just break it down real quick. You've got, let's just say that involves perhaps some negative gearing. So that's great for tax purposes. Income is coming in directly to you, so you pay tax on that. Again, if it's negatively geared, then perhaps you don't pay tax really on the income component. So you go along your journey, you get to a point where all of a sudden the bank says, hey, you're no longer able to buy any more properties. You might be up to your third or fourth property, and all of a sudden they start giving you less and less in terms of loans that you can obtain. So ultimately, you kind of get stuck. You're like, all right, well, that's it. My journey is over, right? So this is where we kind of give you alternative options. So if we go down the path and look at, all right, what else can we have? How else can we purchase a property? We've got other options like, for example, a bucket company, right? Which is an entity that you could utilize, which will then hold your investments. You've got things like family trusts, and super. You could potentially use your super as well for these purposes. So our role as the advisors within the mix of accountants, brokers, etc., is to make sure that it works for you from a long-term perspective, right? So all of these structures, so yourself, company, trust, self-managed super fund, or super, right? They all have their pros and cons. So you want to make sure that you're 100% across that and you know exactly what you're playing with it. You remember a few episodes ago I said, you want to have choice and you want to play within the rules that you are given, and you want to make sure that you know those rules before you embark on anything. So what are the advantages, of going and looking at an alternative structure? Well, the advantage is that all of a sudden you're creating another entity that is no longer linked to you from a serviceability perspective, right? So whilst you might be as a group in terms of yourself and the partner, or if it's just you, unable to service any more debt, then a company or a family trust structure will potentially give you an option to acquire more assets with a different set of rules that apply on how to maintain that property from a debt repayment perspective. There's also other advantages there too, right? So, for example, once we establish what sort of structure we use, we then go through and talk about the cash flow, right? Because ultimately, when you have the investments in your personal name, all the income is coming directly to you, right? So you cannot redirect that. Whereas the other structures allow you to apply a method where you can redirect who receives the income, right? So that's typically done through a family trust. So family trust has a discretion. So let's just say you bought something within the family trust. Let's just say property, just staying on the theme, and that delivers income. All of a sudden, you've got the discretion as to who is going to receive that income within your immediate family. And what's the advantage of that? Well, if, for example, I'm earning 100,000 and my partner is earning 50,000, well, all of a sudden, we've got a difference in tax breaks, right? So I don't want to receive any more income because I know I'll be paying tax at 30+%. Whereas if I pass that on to my partner, then my partner will be paying less tax, right? So all of a sudden, there's a bit of an advantage there, right? So I'm now manipulating what I'm doing, how I'm doing it, and I am getting benefit out of that, as opposed to, again, keep it in my name, 50-50, right? So I'll get 50% of income, my partner gets 50% of income, but our tax is completely different. So we've got good morning, Sonia. How are you? Good to see you. Donna Rose, good morning. How are you? And yes, good morning, Sonia. Looks like you guys know each other, which is awesome. So let's just say, for example, you're a high income earner, right? So all of a sudden you're at a top marginal tax rate, and realistically, any income that you receive now from any of the investments, you're paying tax at 47% tax rate, right? So perhaps, family trust might not be an option, because remember, we spoke about it maybe several episodes back now. What's the purpose of a family trust? It's a flow-through structure, so it has to pay out income. So if yourself and your partner are both high income earners, then perhaps it might not be the right entity to receive that end income. So we go down the scale, right? So what's the next thing that's available to us that I mentioned earlier? And that's a company, right? What's cool about the company is that it doesn't necessarily have to pay out any of its earnings, right? So it can retain earnings within itself. And what's the tax rate within the company? The answer is 30%, right? So all of a sudden, you're going from 47% in your personal name down to 30. Again, right? We're playing within the rules, and we're identifying how can we get the best outcome on your position, right? So we've established that as a high income earner, I'm no longer interested in receiving any more income personally. So now I need to look at entities. And if I'm not receiving any income, so what am I doing? Well, maybe I'm preserving that, I'm building that out within the company, and down the track, right? So we've got a phenomenon called franking credits that get built up within the company. We'll touch on that in the future because it's a big topic. But ultimately, you could use that in the future to pay yourself a tax-effective income that you could then, I guess, one of the previous episodes where we discussed what can you do to retire or, have the flexibility to finish work earlier before reaching the age where you can access your super. Well, that could be one of the mechanisms there, right? That could be a mechanism where you've got a structure that is being built out way in advance, right? So we're talking about years prior. So you're working in the past to give yourself the present and the future, right? So that will then bridge the gap in your income. So, okay, we've got, hey, good morning, Tim. Thank you for jumping on. Good to see you. And then the last structure that we've got is super, right? So again, super tax effective. We all know 15% tax within that. But, like I said, there's always pros and cons. You got to look at the trade-offs. So what are the trade-offs? Personally, right? We've got access to the asset. We can look at it, like we can go and we can sell it. We can access the money. Income is coming straight to us. Amazing. Company, right? Seems to be, we don't necessarily own it because it's owned by another entity. Family trust. Great. That's probably the closest that you're going to get in terms of having an asset that you can feel like it's partly yours. Self-managed super fund, again, separate entity. The trade-off of a self-managed super fund and having an asset in it is that you have to meet conditions of release, right? And those conditions of release really, you got to be age 60 plus to start looking at accessing anything. So if you're someone who's just starting to accumulate your investments, say in your early 30s, then the question must be, well, hold on, can I hold this investment for the next 30 years, essentially, right? 25 to 30 years within that entity without having any access? Because ultimately, most of the benefits typically tend to stay within the structures as well. So, things like negative gearing within the company, that stays within the company. It doesn't flow through to yourself. Family trust, similar thing, right? Personally, you've got access to everything, but then obviously you don't have any tax advantages there. So Coming back to my conversations with clients, there's no one size fit all type of response, right? Because it obviously depends on your circumstances, where you sit on the tax ladder, right? So if you're sitting quite high up, then realistically, we're gonna have a conversation about structures. But if it's only your first or second property, then maybe it still makes sense for you to have that in your personal name, and perhaps utilize some of the negative gearing to help you reduce your personal tax. So there's pros and cons again, right? Because down the track in the future, if you sell that property, or when you sell that property, the capital gain tax may also be an issue. So you got to look at the full picture, not just when you purchase it, but also when you sell it, and have an exit strategy all the time. Similarly to, I just spoke recently to a couple who were sort of like early to mid 50s, and they were just jumping on the property ladder, and they wanted to know, should they buy it in their personal name or somewhere else, or just because they heard about it somewhere else. And I said, look, ultimately my role is to explain the pros and cons for you in this regard, and then from there we can work out the cash flow, the capital gain position, what are the pros and what are the potential gains in the future that we might be working with, and how it's going to impact on you. Because again, with property, you're looking at 15 years sort of average investment time frame. So you've got to be looking at, well, what does that future look like? Obviously can't predict anything, but you want to make an educated guess as to what that position may look like. Capital gains tax, I've mentioned a couple of times now. So you got to understand what are the rules around those, right? So if we go through the structures that I just mentioned, personally, 50% tax discount after 12 months. And this will apply across all of them, apart from the company, right? The company does not get capital gains tax advantages. So it basically starts at zero. So no 50% discount. But the tax rate is 30%. All right. Whereas, family trust, similar to personally, you get 50% tax break after 12 months. Inside super, it's 1/3. Right. So you get a discount of 1/3 after 12 months of ownership. I'm just reading a comment from Tim. So it also depends on how big portfolio you can and want to build. Everything has its pros and cons. Personal name, you will run out of serviceability, stops most investors unless they increase incomes. Yeah, that's correct, Tim. And that's, perhaps one of the, like this comment here is probably one of the most common ones that I get in my conversations, right? Serviceability, yes, definitely pros and cons around everything. But, unless you have a strategy around how or what you're looking to achieve, it's kind of like whichever way you go, you'll probably end up getting there wherever you want to be anyway. It just depends on, what do you do in that period? What sort of advantages are you taking along the way? So, yeah. Oh, absolutely. The first hurdle is really serviceability in your personal name. I always have a question. Whoever has property, like more than 4 properties in their personal name, I always ask why. What's the strategy behind that? And I guess, what's the end goal that you're looking to achieve? Because there should be no reason as to why you're not using a different structure for you to expand your portfolio and build on that in the future, whilst also taking some tax advantages. Because ultimately, right, not only are you limited by your serviceability, on the opposite end, you're also limited by how much tax advantages you can have, right? Because there's only so much tax that you pay, right? So if your expenses exceed your tax, well, what do you think happens? Well, you don't take full advantage. This is where you all of a sudden start to actually hurt yourself from what advantages you can apply. you still, it could be carried forward into the future to offset some of the income, but ultimately you want to be as efficient as possible, because what's the aim here? It's not about, it's not about just having 10 properties with no purpose. The idea is that you're building out a portfolio that will ultimately increase in value in the future, which will then replace your, employment income and give you that flexibility to make choices. Thanks, Sonia. Great to see you. Catch you soon. Think about it this way, right? Have the right team around you, help you, guide you in terms of how do you do your investments, how you structure them, what are the income, expenses that you've got along with those properties. Because again, you remember, properties are different. Some are really high in income, maybe low in capital growth. Some are very high in capital growth, low in income. So you want to structure yourself in a way that are applied for that particular asset. So I hope this kind of gave you a bit of an idea as to what we kind of speak with our clients about, right? Because ultimately, right, it all starts with a conversation and then apply to you, right? Don't go out and sort of say, hey, all right, I'm going to get a company or family trust to help me build out my investments. Seek advice, make sure that it fits your particular strategy, and then go on that journey, right? And don't expect things to happen straight away. It does take time, but you got to stay committed. So I wanted to touch on something else this week, but I might save that for next, given the time frames. But look, I hope this sort of high level structure sort of episode gave you something to think about. Go away, have a look at what you're currently doing, and if you, for whatever reason, are doing things that may perhaps not be as efficient, reach out and we can have a chat. All right, guys, I hope you all have a good Thursday and the rest of your week, and catch you next week. All right, see you later. Bye.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.